Earnings remain in focus today. We've got results from a slew of Canadian companies. Let's get perspective on some of the themes emerging from this season. We're joined by Lyle Stein, president of Forvest Global Wealth Management. Lyle, thanks for joining us as ever. Any big themes, anything, any major, let's say any major trends in corporate earnings that are jumping out for you?
Yeah. Thanks, Andy. Good morning. It's interesting. As you look at the quarter, earnings are coming in somewhat as expected, but there is one caveat that I think is worth looking at, and that is don't miss expectations. If you miss expectations, your stocks are getting hit in ways we haven't seen in a long while. And FactSet does a nice summary every week of what they call earnings insight. And we've seen it. You know, the torpedo stocks are the ones that are down, and they're getting hit because their earnings are disappointing. So the key thing is when you have a momentum-driven market at close to all-time highs, you better make sure your numbers are met.
And what about, even just a few days ago, we were hearing, there are jitters in the market over AI valuations. Maybe we could throw up a 1-month chart for the NASDAQ 100 as a proxy. Do you think those fears seem to have eased over the past few sessions?
I think so. I mean, we did see, stock like Meta got hit on its earnings. Amazon was kind of okay. Other stocks did okay. But, never has so much been owed by so many to so few, if you can quote that old historical line.
Good one.
And this is still the focus. The good news is their earnings are growing nicely, but the expectation going forward of that growth is slowing. And the hope is the rest of the market picks it up. And the big issue, again, when you're trading at all-time highs and you have a momentum-driven market, is if you disappoint, they take no prisoners. And that's kind of the theme I think we're going to see, not just this quarter, but coming into the beginning of next year as we're reporting fourth quarter numbers.
C&Q, a focus for many investors who invest in the oil patch. There was an earnings beat. I think it was Raymond James saying, though, a lot of that apparently, or the cash flow beat, fueled by tax considerations.
Yeah, they did have a wonderful cash flow beat. I think it was up 20% compared to last year. The key thing here is the stock or the company has performed well in an operating environment of very low oil prices. The big question going forward is a $60 going to be the floor, or may we break $60? I saw $59 on your screen just a minute ago. So the question is, what can they do in a lower oil price environment? But nonetheless, those are very good numbers. They continue to return this cash flow to shareholders. And in a world where dividends are important, this is quite good for investors in not just C&Q, but the oil patch in general. They are returning money to shareholders.
Your feeling, though, is natural gas holds more promise right now than crude?
Yeah, we have been big believers in natural gas as a transition theme to ultimately will be something like nuclear power. If we're lucky, we get fusion. But in the meantime, the oil price has softened, and oil is a global commodity where natural gas is much more of a North American commodity. And we would much rather play gas through a variety of places, whether it's producers in Alberta and the West, and then pipelines or distributors. We just feel much more comfortable in that area because it's not impacted by what's happening in the Ukraine or what's happening in the Mideast.
The valuations broadly, Lyle, I mean, in a way, you could argue what do valuations matter? Stocks are worth what somebody will pay for them, or the next fool is willing to pay for them. Are you concerned, though, it's a frothy market overall?
Yeah, frankly, we've had that concern for a while, and the market continues to go up. I mean, that's evidenced of, I would say, buyers who see a scarcity of stocks. And we've talked about that over the years, that there just aren't as many stocks to own.
Right.
But nonetheless, multiples are high. And just the other day, I did a quick study. So again, Earnings Insight, I think, quotes the S&P multiple going forward of 23 times. That's historically high. And interest rates, which drives what level people are willing to pay for earnings, the PE ratio, are higher than that 25-year average. So in theory, we should be paying a little bit less, but I think part of it is the scarcity value. And the difficulty in this market is the scarcity seems to be in the names that everybody wants to buy. They're chasing the big cap AI names, and the rest of the market isn't too unattractive. The question is, going forward, is the economy going to be as strong as it's been? And, that's a whole nother kettle of fish at this point.
Whole other kettle of croissants, as a friend of mine used to say.
Okay.
Finally, cash. Of course, the investment business is a sales business. They want you to stay invested all the time in many cases. But you say it could be a good idea to have some cash in your jeans.
Well, exactly. And the reason to hold a little bit more cash is, again, the market's at a high, valuations are stretched, and when you disappoint, stocks get hammered. And so, today, for example, we're looking at some of these names that are down 20%. Thomson Reuters, an example, Constellation Software. There's lots of names that have gotten hit in here because they disappointed. The story really hasn't changed other than a quarter. So this is a good time to have a buying reserve, and it's not like it's burning a hole in your pocket, or the alternative. You're not losing a lot of money because markets have been flat over the last little while, as your chart of the market showed.
Yeah, it's interesting how the TSX has been going sideways lately, looking at the overall index. Lyle, thank you very much. Lyle, just update me. What about World Cup tickets for the games in Canada? Are you making any progress?
Not at all. Not at all. Talk about momentum investing. Those tickets are those tickets are, how you say, very, very pricey.
Oh my goodness! Thanks very much. I know Paul Bagnall won't be happy about that either. Thanks very much, Lyle. Lyle Stein, president of Forvest Global Wealth Management.